Most real estate investors think a loss is the worst thing that can happen. They hear the word loss and immediately assume it means failure, bad investing, or wasted money. But here's the truth. In real estate, a loss can actually become one of your biggest financial wins if you know how to use it strategically. Today, we're going to break down exactly how smart investors turn losses into wealth-building opportunities and how you can do the same, even if you're just getting started. Let's start with something simple. Real estate is not like a regular job. In a job, if you lose money, it's gone. There's no upside. But in real estate, losses can create tax advantages, cash flow strategies, and long-term wealth moves that most beginners don't even realize exist. Let me give you an example. Imagine you buy a rental property. You spend $250,000, you rent it out, but the first year is rough. Repairs come up. The roof leaks. The tenant moves out. Your expenses end up being higher than your rental income. On paper, it looks like you lost money. But strategically, that loss might actually save you thousands of dollars in taxes. Because real estate has one of the most powerful benefits in the entire investing world: depreciation. Even though your property may be going up in value, the IRS allows you to deduct a portion of the building's value every year as if it's wearing down. So even if you break even in real life, you could show a loss on your taxes. And that paper loss can reduce your taxable income. That means instead of paying the government more money, you keep more of your cash. That's turning a loss into a win. Now let's talk about the real reason smart investors love cost breakdowns. Because real estate investing isn't just about buying property. It's about understanding where your money is going and how every expense can become part of a bigger strategy. Let's break it down. When you buy a property, you have upfront costs, your down payment, closing costs, inspections, maybe even renovations. Most people look at those and think that's money gone. But investors look at it differently. Renovations increase property value. Closing costs become part of your investment basis. Repairs may be deductible, and depreciation starts working for you immediately. So the first mindset shift is this: a loss is not always a real loss. Sometimes it's just part of the investment process. Now here's another example. Let's say you buy a property and you spend $20,000 fixing it up. Maybe you don't see that money back right away. But after renovations, the property appraises for $40,000 more. That's not a loss. That's leverage. That's forced appreciation. And that's one of the fastest ways investors build wealth. You're strategically spending money now to win bigger later. Now let's go deeper. What happens when you sell a property at a loss? Most people panic. But experienced investors ask one question: how can I use this loss to offset gains elsewhere? In investing, capital losses can offset capital gains. So if you made money selling one property but lost money selling another, you may reduce or eliminate the taxes owed on the profit. Again, that's turning a loss into a financial tool. Now here's where the wealthy play the game differently. They don't just focus on income. They focus on tax strategy. They focus on long-term cash flow. They focus on building assets that pay them for life. And real estate is the ultimate wealth vehicle because you can earn money in multiple ways. Cash flow from rent, appreciation over time, loan paydown as tenants pay your mortgage, tax benefits like depreciation, equity growth, and the ability to refinance and reinvest. So even if one year looks negative, the overall wealth machine is still working. Now let's talk about one of the most powerful strategies investors use: turning temporary losses into passive income wins. Sometimes you'll have a property that doesn't cash flow much at first. Maybe interest rates are high. Maybe rents haven't increased yet. But over time, rents rise, expenses stabilize, and suddenly the property becomes a cash flow asset. That's why real estate rewards patience. A short-term loss can create long-term passive income. Now let's talk about cost breakdown, because this is where beginners win or lose. Every investor should understand these main expense categories: purchase costs, financing costs, operating expenses, maintenance and repairs, vacancy reserves, property management, taxes and insurance. When you track these properly, you stop guessing. You start investing like a business owner. And here's the key: real estate is not gambling, it's a business. When you treat it like a business, you can strategically plan for losses and turn them into wealth-building wins. Now let me give you a mindset lesson. Most people fear losing money because they think it means they failed. But investors understand something different. Losses are part of scaling. Every successful real estate investor has had bad tenants, unexpected repairs, vacancy months, market downturns, renovation overruns. But the difference is, they learn, adjust, and keep moving forward. Because real estate is a long-term wealth game. Now here's your biggest takeaway today. A loss is only a loss if you don't learn from it or use it strategically. When you understand tax benefits, cost breakdowns, and long-term investing, a loss becomes a step forward. It becomes part of the plan, and that's how smart investors build wealth. So if you're just starting out, don't get discouraged by early expenses or setbacks. Focus on the bigger picture. Track your numbers, learn the tax advantages, build cash flow assets, and keep investing strategically. Because real estate isn't about never losing, it's about turning every challenge into a win. And if you want more weekly strategies on building wealth, saving taxes, and creating passive income through real estate, make sure you subscribe right now to Smart Realty Secrets. I'll see you in the next video.